Now, a new round of banking regulations, the result of the Dodd-Frank Act. How will this affect investors and banks? Plus, a stock market that continues to post gains, the 6th consecutive trading session that stocks are rising. Well, my next guests are watching all of this. We have Jason Su, the Chief Investment Officer at Research Affiliates. The firm has developed an index that measures growth in equities and in bond markets. Jason is also the co-author of the book, The Fundamental Index, A Better Way to Invest. And we have Bob Gelfond. He is the Chairman and Chief Executive of MQS Asset Management. He says that new banking regulations aren't good for the industry or for investors. Gentlemen, good to have you with us. Jason, Bob, appreciate you coming in. Bob, let me just sort of see if I can understand. You really believe that all of the work that the Federal Reserve is doing right now is going to come back to haunt us, and not in a good way?
I think it's very likely. It's almost impossible that they'll get things exactly right. The idea that you could put a group of academics, and no matter how experienced, no matter how bright they are, in a room together, and that they're going to figure out exactly what the price of money should be, and that they're going to get that exactly right, I think is really ridiculous. I think it makes about as much sense as putting a bunch of smart economists in a room, having them decide what the price of bread should be or any other good. And because of that, I think the aggressive policy that they're engaging in now is adding a lot of risk to the economy. Maybe not right now, but at some point in the future, I think that's going to come to bear, and it's going to make for difficult times, I think.
Jason, what do you think? We're going to end for difficult times, at least maybe not short term, but sometime in the future with all of the easy money that is being created?
Oh, absolutely. Right now, what you're seeing is an asset price inflation driven by too much liquidity. I don't think the underlying fundamental is there to support a kind of valuation ratio we see. Over a long haul, I think the market will be disappointed.
Over the long haul, but how far do we have to wait until we get to the long haul?
That's the question. My forecast is within the first half of this year, the liquidity will continue to buoy the market upward and forward, and so there's not a lot of risk in a 6-month intermediate horizon. Beyond that, I think there starts to be risk to the downside.
All right, so Bob, if we were to agree with you and Jason, what's an investor to do? How do you protect yourself? It seems as though even just holding cash, at least according to your scenario, is a recipe for disappointment.
Well, I think I don't want to portray a doomsday environment somewhere down the road. I mean, the economy left to its own devices will grow, and it's possible that a lot of that organic growth may help us avoid a truly awful situation. But I think it's prudent for any investor to be well diversified. You don't want to be overly exposed to an inflation scenario. You don't want to be overly exposed to a deflation scenario. And so I think it's very important to have a true mix. Unfortunately, a lot of investors, they may have 20, 30 different things in their portfolio, but they tend to be affected by the same underlying themes, whether it be deflation or something else.
So what about the dependence on fiat money? I mean, at one point or another, you got to turn everything you have into cash or into money. Would you not be using the U.S. dollar? Would you be using something else, or would you be using gold as a store of value?
Well, I think it makes sense to have some of your money in gold as an individual. I mean, the dollar is the world's reserve currency. I don't think that's going to change anytime soon. I would like to see a monetary policy that would be more market-driven than what we have today. Maybe that could allow the dollar to survive in some form. That may be the best path, the easiest path to getting there.
Jason, what about emerging markets? I know that you've been focused there. Is that a way for people to maybe hedge their bets a little bit?
Oh, absolutely. I mean, emerging market is the right hedge and the right diversification for a U.S.-based investor. They have the opposite demographics, young and growing, while we have the aging demographics. They have the opposite fiscal issues, running surpluses or running massive government debt. And, of course, they have a generally trade account surplus against us. So the opposite macroeconomics means the kind of risk exposure that we as U.S. dollar predominant investors should be focused at.
All right, I want to thank you very much, gentlemen. Jason Su, Affiliated Research, and Bob Gelfond coming to us from MQS. Appreciate it. Thank you.